The message from a voice that has a lot of weight in terms of expertise, experience, and optimism for the future could potentially turn around your financial situation. It's an entreaty, a call to action, and an assurance of something extraordinary. In this gripping movie, we explore the future of Tesla and electric vehicles while figuring out Cathie Wood's cryptic message. But in my opinion, it has little to do with the strike itself. Rather, it has everything to do with a change in customer tastes toward better, more reasonably priced cars. That is, electric cars. Tesla is causing that price down by merely passing cost savings through to its customers. I think Tesla will gain from it because of this. We get complaints from people saying they can't afford these autos. Rishi Sunak is pushing back his target of doing away with internal combustion engines from 2030 to 2035, according to stories in the UK news. Are we getting too excited about this shift? No, no, no. That is not what we think. In fact, 2 or 3 years ago, the whole cost of owning an electric car was more than that of a gas-powered car. But since this is the United States, things might be a little different. Will insurance soon have that sticker price? Absolutely, insurance is included. There are regional differences, as I have previously stated, but insurance is one of them in the US. Tesla is so sure that there would be fewer incidents and fatalities involving its vehicles that they are even willing to give insurance. Consequently, everything is undoubtedly a part of it. Our investments have always been long-term. An abrupt spike in interest rates ruined what was a really good strategy. Join us as we explore the intricacies of Tesla's stock, the whole cost of purchasing an electric vehicle, and the direction that finance is taking. What mysteries is she holding back to divulge? And what exactly is she asking you to do with those shares of Tesla? As we dig deeply into the world of Tesla and the electric vehicle revolution, we will look at strategies, challenges, and the unwavering belief that is captivating investors worldwide. We'll also uncover the enigmatic allure of Tesla's stock, which is driven by substantial incentives and an unwavering faith in a visionary. Are you ready to embark on this exciting journey with us as we navigate this financial maze? The journey that lies ahead is full of chances and twists, but it also has the potential to bring about revelation and slash or insight. Are you set for the disclosure? Don't pass up this intriguing exploration of the finance and innovation domains. Continue to participate, subscribe, and stay in touch. Welcome to Tesla Stock News, and let's get started. A broader picture of the EV environment is being offered in the realm of electric vehicles. It's probable that the current events in Detroit will have an impact on Tesla rather than just Tesla, especially if a strike causes production bottlenecks. However, the bigger picture suggests that customer tastes are shifting, not just because of labor difficulties, but also because more and more people are choosing affordable electric vehicles. Leading this change is Tesla, which keeps cutting prices by passing cost savings through to its customers. Some may argue that electric vehicles are still regarded as being expensive. For instance, the United Kingdom's Chancellor of the Exchequer, Rishi Sunak, decided to accelerate the deadline for the phase-out of internal combustion engines from 2030 to 2035. This decision has sparked discussions on the feasibility of this shift. Some have questioned whether or not consumers can truly afford to convert to electric vehicles, but let's consider an essential factor that's occasionally overlooked in this conversation: the total cost of ownership. In the US, there has already been a significant change in this perspective. Electric vehicles are currently advantageous for drivers from an economic and environmental standpoint due to their increasing popularity. The total cost of ownership of an electric vehicle, EV, is currently cheaper than that of a traditional gas-powered car, even after insurance is taken into consideration. This modification reflects the rising affordability of electric vehicles. Tesla, the industry leader in electric car sales, has further raised this affordability element. Because they have such faith in the dependability and safety of their cars, they incorporate insurance as part of the ownership package. This exclusive service not only makes life easier for Tesla customers, but it also increases the appeal of choosing an EV for those considering switching to electric cars. It's a compelling case. Consequently, it's critical to recognize that the environment is changing, even though the UK's choice to delay the phase-out of internal combustion engines raises reasonable doubts about the feasibility of the transition. Recent changes in the total cost of ownership, particularly in the US, make buying an electric car not only a prudent financial decision, but also an environmentally good one. ARK Investment Group is using an innovative and technologically advanced approach. Using a first principles technique and in-depth research, ARK is blazing its own trail, in contrast to traditional diversified funds like Capital Group. It centers on companies that have the power to drastically alter whole sectors of the economy. While conventional funds may have a close relationship with broad benchmarks, ARK's method does not. This discrepancy demonstrates ARK's commitment to diversity and its belief in companies that have the power to radically change the path of history. In the coming years, the most crucial question is whether this less varied approach would prove effective. ARK believes that by making long-term investments in companies that are revolutionizing their industry, it can overcome challenges such as the recent spike in interest rates. ARK is steadfast in its mission to assist companies who are promoting disruptive innovation, even in the face of exceptional market situations. The market is closely monitoring the Federal Reserve's actions, so the strategy's resilience will be put to the test right now. The expectation of higher rates in 2021 and 2022 contributed to underperformance, whether or not there is another rate hike. The question then becomes, how would renowned investor Cathie Wood modify her strategy in light of these bleak times? Given the current dynamic financial situation and the challenges posed by the epidemic, how does she adjust her approach? It's important to emphasize that Cathie Wood never wavers in her commitment to innovation, even in trying circumstances. She believes that creativity thrives in these challenging environments. Her portfolios are outperforming because, in a more challenging climate, they are gaining market share. The path to recovery is to put an emphasis on expanding profit margins and revenue growth. Significantly wealthy retirees have recently shown an unwavering faith in Cathie Wood's approach. These individuals, who are occasionally referred to as old farts by others, have made large investments in innovation, technology, and companies like Apple. Their investment decisions have paid off because they choose to ignore the buzz from financial TV or radio. With the volatility of the past few years, can the Cathie Wood strategy be effective for the next 1, 3, or even 5 years? Cathie believes that the worst of the interest rate surge is behind us, which significantly impacted performance. She claims that her strategy is now ready for the mainstream, which is supported by the recent acquisition of Rises, a company that focuses on global metatrends in Europe and the UK. Cathie notes that the early 2000s dot-com and telecom bubbles sowed the seeds for the current market dynamics. Though its growth may be slowing down, Tesla still has room to grow at a cost that is competitive. Given that the price of Tesla's shares has decreased from a year ago, the stock is now more attractive. Moreover, several business endeavors of Tesla, including as cost-cutting, insurance, and completely autonomous driving, are undervalued. Tesla is positioned to achieve greater profits as a result of its expansion and ongoing pursuit of its 2020 Battery Day goals, making it an appealing investment opportunity. Strong revenue growth is predicted based on Tesla's predicted development trajectory over the next 10 years, possibly surpassing management's ambitious 50% target. This viewpoint presents investors with a seductive opportunity at the current stock price. It's important to keep in mind that Tesla missed its internal target of over 50% increase in deliveries in the most recent quarter, only managing a solid 40% growth. To fully grasp Tesla's potential, we need more transparency from the firm, as well as in-depth analysis and future plans. With the use of such information, investors may more effectively align their expectations with reality. Management's stated multi-year 50% year-over-year growth aim is excellent, but it lacks the precision that investors often demand. The larger Tesla gets, the more vulnerable it is to fluctuations in the economy. Considering that Tesla currently manufactures more than 1.3 million vehicles annually, even modest economic downturns may have an impact on consumer demand. This calls for yearly goals and more precise guidance. Furthermore, growth-oriented equities like Tesla are particularly susceptible to valuation shifts brought on by little revisions to growth rate estimates. Investors are quite keen to believe that these growth projections are true. Now let's examine the incentives that would be necessary to draw in U.S. customers. Thus, the query is, will price changes be required? It's likely that Tesla will implement minor price reductions to ensure that a greater number of its vehicles, the Model 3 and Model Y in particular, would qualify for the Inflation Reduction Tax Credit. Using this strategy could be essential to surviving an economic crisis. For Tesla, boosting strong demand growth is an essential tactic. How are they going to achieve this? However, they plan to reduce the cost of their platform in the future year. These reductions are intended to foster organic demand growth, which is a crucial component of Tesla's growth strategy. A staggering 1.6 million deliveries are projected in 2023. To be honest, though, the real world often takes unexpected twists, even though Tesla had previously stated that they anticipated to grow at a rate of 50% over a number of years. Dynamics of the market, unforeseen challenges, and global economic. Every circumstance is relevant. It's critical to consider the bigger picture. In the fast-paced world of finance, Tesla may not always live up to its promises, but even a small mistake might have far-reaching effects.